Hi, well, now we're getting ready to start the exciting part, the fun part. This is the part that I really enjoy. I love working on financials of businesses. And I want you to find some joy in it as well, because if you find it something fun in here, you'll enjoy doing it and it will be something. So what we're going to do here, we're not going to actually develop it. That's going to be something you'll be doing as part of your exercises or your homework. But we're going to talk about how these things work together to give you a better idea of how all this flows together. So where are we in this process? So we started at the very beginning, where we talked about businesses and what did we want to learn from businesses that failed? What can we avoid in learning from others? What are the best practices out there? Business Model Canvas is a way for you to chart out or plot out your full business on a single piece of paper to really understand and give you a bird's eye view of what your business is all about. And when you're developing your business model canvas, everything you put on there at first, they're all guesses. They're all guesses, hypotheses, opinions. Well, when you take your business plan someday to talk with somebody about it, they don't care about what you think. They care about the facts. And so how do we get those facts for our business model canvas? And the way we do that is we do something through interviewing, what we call customer discovery, going out and talking, having a discussion with our potential target market. And there's a certain way that we need to do that discussion with them. And we talked about that in the customer discovery section. Then we looked at competitor analysis, because there we're looking to see, are there any opportunities that we might have missed from other things that we've looked at? Are there opportunities out there that our current competitors aren't even addressing? Maybe they're just in a reactive mode rather than proactive mode, and they haven't had the chance to see what was going on in their environment. So that was the purpose of that. And then we had the discussion about go to market. How do we go to the market? How do we generate our revenues? And how does that reflect on us and our brand? We talked a little bit about in the previous module about some financial assumptions, a little bit about startup costs and what those things look like. And the assumptions that we're making when we're doing all of our projections. So we did that in our last module. So now we're going to start talking about creating those. But before we get started, let's talk about cash is king. As you remember from the very first module, long time ago it seems like right now, doesn't it? But earlier today in the morning, we talked about the importance of cash, because one of the main 3 reasons that companies failed that we saw was that they had a lack of cash. Cash is king. Now, on these next few slides, I have a direct quote on here about cash is king. And the reason I gave it as a direct quote is that I truly believe that this has importance to you and reading it. When we're looking at sales and we're trying to project what our sales are going to be, project them monthly. And we're talking about cash sales. What part of that sales is cash? Which part is going into accounts receivable? But when we're doing our cash, we want to project it monthly. Some people try doing it quarterly or doing it yearly. Don't do that. Project it monthly, because it's through that monthly that we're able to see trends, that we're able to see seasonality, that we're able to see the growth, because it's on a monthly basis that we have to pay our bills. So it only makes sense that when we're doing our projection of sales, that it is done on a monthly basis as well. The next is we want to make sure that we don't forget receivables. Not every sale that we have is going to be in cash. As we've seen in the pandemic, a lot of people don't even want to carry the actual physical thing of cash, right? Not everybody wants to do that. So there's a lot of credit card sales. Well, you need to be looking at your banker to see how soon do you get or receive those credit card funds. Because while you're waiting for those funds, they're going into accounts receivable. If you're doing a purchase order for a sale, then that might be not for another 30 days that you actually receive the cash from that vendor or from that customer for the sales that you gave them. So don't forget about accounts receivable when you're doing your cash flow. Accounts receivable represents those monies that we expect to receive in the form of cash in the next 30, 60, or 90 days. And on here it has 180. And it's going to depend on your industry. Because as you're looking at your industry and doing the industry analysis, you'll look to see what is the normal turn of accounts receivable. How long does it normally stay out in there for other people in your industry? And if you ever have an account that lasts longer than that, you want to make sure you follow up with them to see if it's ever going to be cash. And if it's not, then you need to write it off as a bad debt. Consolidate predictables is a suggestion here. Every business has a core of, they call cash burn. Cash burn, because burn is how much we have to spend regardless of having a customer or making a sale. What are our expenses that we're going to have every month that we know we're going to have? And regardless if we have a sale or not, what are those expenses? And that is what we call our burn rate. Burn rate. So how much are you burning every month in order to keep this business up and running before you have a sales? So even if you have no revenue, how much is it costing you to run this business? And you can hear people talk about in the tech industry, sometimes they say they have a burn rate of $1 million a year. It's like, wow, okay, so there's got to be potential that's coming on down the road, right? So the burn rate, it reflects how much cash that needs to go out the door that we have to spend every month to keep this business up and running, regardless if we have a sale or not. Adjust for growth. Be reasonable in your estimates for growth rate. And when we have a growth rate, when you're trying to increase, like say you're trying to increase your sales. Well, if you're trying to increase your sales, that means you're going to have to increase some of your assets, right? You have to increase assets. Well, to increase assets, you need to get money from somewhere. You either have to get it from cash, and if you don't have cash for all those needed assets, you're going to have to get something from liabilities, or you're going to have to put money from your own pocket into the business that you have. So it's really important for you when you're looking at all of this terms and when you're thinking about growth, is that where is that money going to come from? You need to have cash for that growth. And so many times you're going to see an increase in equity or liabilities when you're trying to have a large growth in terms of the number of sales. Also, when you have growth of sales, there is a certain point where your employees are past their capacity and you're going to have to add new pieces of equipment, new people, things of that sort. So keep that in mind when you're looking at adjusting for growth. At what point are you going to have to change your operations to accommodate that increased sales that you're projecting? Because it's not a straight linear line. Your capacity is only going to work for a certain range of sales. Understand your operations. At what level of sales does your level of operations right now support? At what point are you going to have to increase your capacities within your business, within your organization to meet additional sales? Really understand that underlying concept. And lastly, plan for unforeseen. Many times you will see that when you're looking at startup costs, they'll say project at least 1 year to 18 months of operations or working capital. How much money is it going to keep you alive to up and running, regardless if you have any sales? What is that you need to have on hand for working capital just to keep your business alive for the next 18 months in case sales are not what they want them to be? And there might also be an additional line that you have on that startup expense line that is for unforeseeable expenses, things that you had not planned for, things there was no way you could have seen it because it was something very unique. For instance, my first business that I bought was a restaurant. I was on vacation. I was living in Lubbock at the time, and I went on vacation at Clearwater Beach. And that was at Thanksgiving. And I went there and I saw this restaurant. It was for sale. It was right across from the hotel. And wow, I was looking, it was like, man, you know, if I buy that, I could turn that around and make money. And so I kept thinking about it, went back to Lubbock, and I kept thinking about it, and I kept thinking about it. And so I went back over the winter break because I was teaching at Texas Tech at the time. And I went back, and that restaurant, it was still for sale. So you know what I did? I bought it. I was still living in Lubbock, but I bought the restaurant. And I did the things that I said I wanted to do. But there were some expenses I hadn't prepared for. Every city, every county has its own laws. And one of them was at this restaurant that I owned was that you could not change a sign outside of your business without the written approval of the city. Well, I had this sign outside of the restaurant. It looked like a child had drew it. And it was not the brand I wanted to have for my restaurant. So I took it down to have it redone professionally. And one day when I was there at the restaurant, I saw someone taking pictures outside my restaurant. And I went outside. I asked him, well, what are you doing here? And he didn't say anything. He goes, I'm with the city. And I said, well, what is it? Is there something I can help you with? And he said, no, you'll hear from me later. And so pretty soon I get a bill from the city saying that I had removed a sign without their permission. So things like that happen that you don't know about, that you hadn't planned for, that you hadn't prepared for. It's going to happen. So make sure that in your startups, you have a contingency fee for any of those unexpected expenses that you were not expecting. So these 5 rules, make sure you keep them in mind. They're very basic, very simple, and they come from this particular website that I have listed here for you as a reference, which you can see on your handout. So if you'd like to go and look at it. But one of the things I want to make sure I emphasize here again, cash is king. The cash flow statement is so important to your business. The cash statement is driving other parts of your financial business. Really understand that cash flow statement is imperative to being a successful business. You don't have to write in all the transactions, but you need to understand all of those expenses that you have that are going on with the business. Are those really necessary? Are all those expenses going to a valid vendor too, as well, you want to think about. So cash flow, let's talk about it in more detail. Your cash flow statement is going to be showing everything that's going in and out of your business. It's like your checkbook, right? You want to see all the cash that's going in and out of your business. And it's going to help us identify business needs. It's going to help us identify when we might run short. You can never have a negative cash balance. Let me repeat that. When you're doing your balance, when you're doing your cash projections, you cannot have a negative cash balance. All right, if it goes negative, your bank is going to say, sorry, you need to give us more money. We're not going to start bouncing checks now. So make sure you can never have a negative one. But what might tell you when you do have a negative in there that you might need a line of credit to help you over those few months or short time period that you're falling short on your revenues in terms of your expenses. So that whenever you do have that negative, it's going to tell you that you're going to have to do something else. It could be a line of credit. It could be a short-term loan. It could be that you have to fork up more money from yourself or from your friends and families and others. There is a difference between cash flow projection versus a cash flow statement. Projection means that we're trying to predict things. We're trying to predict into the future. where a cash flow statement shows what has actually occurred, what has really occurred into the past. So the projection is what we're doing when we're trying to start our business. And then once we get started, we actually have something started, we want to make sure we rename that statement to be a cash flow statement rather than a cash flow projection. Now, from the current year, we can still have the cash flow statement and have cash flow projections for what's going in the future so that we can look to see what we see trends and things that are going on. So cash flow reports are, both of these are very important because we want to compare them. What was it that we projected to happen right now? And what really happened? Where were we off? Where were our assumptions or our predictions off? Where do we need to make adjustments in how we're running our business? And it will help us become better at running our business when we look at the difference between our cash flow projection and our cash flow statement. There are three parts to a cash flow projection. There's the revenue, there's the expenses or the disbursements, and then there's the projection. So our revenues, those are all of our cash sales. Again, let me emphasize, when we have our cash revenues, that is when we actually receive the cash from our sales. When did we receive the cash from that sale? It might not be the same month that we actually sold the item. It might be 30 days down the road, 60 days down the road. So when we do have a sale, it's either going to be going into cash or accounts receivable. So whenever we have a sale, when we have something coming in, we've got to match it with something else. So where did that money go? So if we do have a sale, did it actually get the cash at that time? Or did we get to the promise of cash later and it goes into accounts receivable? So those are our revenues, our inputs. When do we expect to get all of those? So those are coming in of our cash revenues when it's coming in. Our cash disbursements, those are all the checks, the bills that we're paying during the month. When are we spending that money? Actually spending the money. When does that money come out? Now we can talk about the difference between cash flow and accrual accounting. And I really encourage you that when you're first starting your business, stay with the cash flow basis. If at one point that your business grows and it becomes scalable, you might want to switch to accrual accounting. But I would encourage you, when it's a very small business and you're just trying to get it started, that you focus just on cash flow and not accrual. Because accrual will make it look like you might have that cash, you might have it as an asset, when in essence you really do not. You haven't, you've already paid it. So when we're talking about accrual, you might have prepaid assets, like we prepaid our insurance, we paid it for the year, but then we show that it could be an asset throughout the year because we haven't actually incurred that expense yet under accrual accounting. Well, what happens then is that it looks like that could turn into a cash later when in fact it really cannot, because we may not be able to cancel that insurance policy and get the full refund of any unused money. So be very careful about that. So when you're first starting up as a business, strongly encourage you to do cash flow. Oh, so then we have our disbursements, and then we have our cash flow projections when we're trying to look about where it's going to go in the future based on what we've been at in the past. So here's an example of a cash flow projection statement, or it could be either the statement for projection and the statement for a statement they look the same. The only difference, one is current and one is for the future. So the template itself, regardless if you're doing a cash flow projection or a cash flow statement, they both are looking the same. It's just a matter whether or not it is current and past cash flow or projection, which would be in the future. So in terms of financial statements, the cash flow statement drives all of the financial statements. It is the most important document of all our financial statements is the cash flow. And if you think about in terms of just being a checkbook, that's all your cash flow statement is. It's just a checkbook of what it looks like when money is coming in and when money is going out. It's simply a checkbook. But for every one of those items that are coming in or going out, those items either are going through the income statement or they're going through the balance sheet. The cash flow statement drives the balance sheet and income statement. So the cash flow statement is done on a monthly basis. And then we're going to come up with totals at the end of the year. And then those totals for the end of the year are going to go to either the balance sheet or the income statement, depending upon a type of expense that it was. So the balance sheet and income statement, those numbers, like, so if you're using Excel, if you're using those numbers, should automatically be generated from your cash flow statement. You should not be going in and manually putting in those numbers into the balance sheet or the income statement. It should be automatically developed from their cash flow statement. So if you're using Quicken, Quicken will help you set up balance sheets and income statements. Or QuickBooks is another one that's very popular that people use for their bookkeeping, and that will help you generate it. But it is very easy to do these for a very small business. You can do it through Excel or through any other type of Excel type of document, working sheet type of document to develop it. And I almost encourage you to do it while your business is very small, to do it that way, because that way it helps you really understand the flow between cash flow and the balance sheet and the income statement. So successful business have to understand their financials. And you might say, well, I know someone who is really successful and they don't understand it. Well, during good times, everybody's doing well. But when times start to go not so well and you don't understand your financials, you may not survive the downturn of your business. But having, I can't emphasize this enough. There was a business and they met, there was a corporate business and they had like 4 or 5 different subsidiaries that were under the umbrella of the corporate business. Each business had its own president, and every Monday morning, they would look at the financials, both for the individual businesses and for the umbrella business. And they would look at the different ratios that were going on with the financial statements. Now, none of those CEOs were developing those balance sheets, but they were looking at those numbers and they were looking at trends in those numbers. And what happened was, in 2008, we had a recession. Well, in 2007, by looking at those financial ratios on a monthly basis or a weekly basis, actually, by looking at, they started to see a trend and they started downsizing their business. So when the recession hit, they were prepared for that recession and they went through it successfully. So really understanding the financials is very important. Having to actually calculate and do the bookkeeping, not so much, but you really need to understand those financials to help you really understand and predict what's going on in your environment. So let's go over balance sheets. Balance sheets consist of 2 parts, what we usually call the left-hand side and the right-hand side. The left-hand side are the assets. Assets are anything that add value to our business. They are that, that's probably the easiest way to say it. They include anything that's going to be adding value. So we have current assets. Current assets are any assets that will that will include cash, and then we have other things that will turn into cash within a short time of period, which is like the accounts receivable that we talked about a little bit earlier. So current assets are anything that can or will turn into cash that we can use for operations in the next very short time period, whatever it is we define for our particular business. Accounts receivable are any sales that we've made, but we have not received the cash on that sale yet. And it is an asset only as long as we think that we can turn that into cash. At any point that our customer fails to pay that account, then that will become a bad debt and it's no longer an asset, and we need to remove that from our assets, because assets are things that are adding value to our business. So current assets and accounts receivable, and also when we get down to other current assets, those are items that we could see turning into cash that we can use to pay our current expenditures for our business. So those are where we're looking for in terms of our operations, of our working capital that I would say for our business. Then we have something called fixed assets. Fixed assets are any tangible item, any tangible piece of equipment or property that we have that we use to generate sales. So any equipment that we use to help us generate the sales of our business. It could be manufacturing, it could be a building, it could be a land, it could be fixtures, it could be leasehold improvements, it could be anything of that sort that we are using as part of our business to help us generate revenue. And the fixed assets, when we buy them, we pay them off through the useful life of that asset. And there's different ways of doing that. We can go to the IRS and look to see what they recommend. We as a business might say anything that is under $2,000, we'll expense it because we only expect the life of that asset to be for the current year, that we would have to replace that asset in another year. So we'll just expense it in the current year and not put it on our balance sheet. But land is never depreciated. Buildings are normally depreciated over 30 years. And the whole idea of having depreciation, of writing off the expense of buying that asset over a long time period, is that we're getting the use of that asset over that time period. So we want to allocate that expense of that item to the time period that we've actually had for that. And there's different methods of depreciation that you can use. I would suggest that you talk about it with your accountant as to which ones are best for you. But as a small business and you're just getting started, I really encourage you to use straight line. Just take what the asset value was when you bought it. And if you think it's gonna be 5 years, you divide it by 5 and you expense 1/5 of that every year as part of your depreciation. We have intangibles that we have on here. And this would have to do with if you have a patent that you had to actually get, and what's the expected life of that patent, the expenses of getting that patent, whatever that might be for your business. Many small businesses, unless you have a patent, you probably are not going to have intangibles like goodwill. You might have it if you buy a business, you might put some goodwill in there, but it's very seldom that you're going to have anything else in there. And then total assets are just all of these combined together. Now, remember, balance sheet shows the cumulative picture of our business from inception, from very day one. And that's why we have the depreciation. We're going to see the accumulation, the depreciation of our fixed assets on the balance sheet. And if you're doing accrual accounting, that will show up in the other current assets. And again, I really, really encourage you as a small business, use the cash method first. As you grow and you become a repeatable business and scalable business, then rethink becoming accrual. But when you're first in your startup phase, I really strongly encourage you to do a cash flow and do a cash basis of all of your accounting. Now, let's look at the other side. And when we're talking about a balance sheet, it's called balance because we want it to balance. Our assets go on the left-hand side and our liabilities and owner's equity on the right-hand side. And whenever we make a change on the left-hand side, we'll be making a corresponding change on the right-hand side. So somehow they're always in balance. So our fixed assets and current assets and all of our other assets added together have to equal our liabilities with our owner's equity. So it has to stay in balance at any one time. So as you make a change in something on the left-hand side that is an asset, then we have to have a corresponding change on the right-hand side with our liabilities and owner's equity. So in terms of liabilities, we have current liabilities and long-term liabilities. Current liabilities are any expenses that we expect to pay in the near term, in the current year. Long-term liabilities are those that we expect to pay over the long term. They're not due until after this year or longer. For instance, if we have a loan on our building, well, that building, we're paying it off over 30 years, but the current portion is only the amount that we have to pay on that loan for the current year. Any of those payments that we're going to make on our building after this year would be in long-term liabilities versus the payments we're going to make on that building loan this year will be under current liabilities. So we have current and long-term liabilities. We might also, in terms of our current liabilities, like our vendors, we have customers that may do us on, buy from us on a purchase order, in which case we don't expect to see that cash for more than 30 days. Well, we might do the same thing with our vendors, that we're buying something from a vendor and we say, we're going to buy it from you, but we're not going to pay you for another 30 days. Well, that bill we'll put in here on accounts payable, knowing that we're going to have to pay it later. And we have that, usually you'll have that offset because since you're not receiving for your customers for 30 days, you don't want to pay your vendors for another 30 days so that you can match the revenue with the expense in the same time period. That owner's equity will consist of two different parts. Owner's equity will have retained earnings, which shows a cumulative of all the profit and loss that you have had as a business. And then we'll have an equity portion. The equity portion is the amount that investors have placed into this business since the beginning. So owner's equity will have equity and it has retained earnings. Retained earnings comes directly from your income statement. Equity will come from money that you put into it from your friends, your family, and yourself, things of that sort. So here's a sample of a balance sheet, and notice that it's balanced. Left-hand side, we have assets. On the right-hand side, we have liabilities and equity. And the assets and the loaners and the liabilities and equity side, they have to balance. So notice at the very bottom, they do balance. They balance at 177,000. If this does not balance, you have made a mistake and you need to figure it out. And I gotta tell you, that's one of the fun, I love doing stuff like that, helping people when they're first starting out with their small businesses and their startups and they can't get it to balance. I love to work with people in doing stuff like that. But really understanding this is very important. And I really want to put a plug right now into Profit Mastery. If you are near an SBDC that offers Profit Mastery, I strongly encourage you to take that class because it will help you really understand the numbers, the ratios behind your financial statements. So go to your Small Business Development Center and see if they're offering a Profit Mastery class. And if they are, I strongly encourage that, especially for businesses that are looking at growth. Definitely do that. Go and look at it because it'll help you understand your balance sheet and your income statement and your cash flow so much more. Now let's talk about the income statement. The income statement is like the cash flow. It's a snapshot of your current year's profit and loss. It's going to give you a summary of all your income that you had for the year and all the expenses related to this year that you had that were incurred. And this is where we're going to see our bottom line, our profit, if we're doing right, we're not doing so good, but everything is on the income statement. Everybody wants to jump to the income statement. And the income statement is great, but it only tells you the snapshot for a particular time period. It's usually for a year. It depends on what your business cycle is of whether or not it's a year or not. For most people, it is 1 year. So your income statement is based on a year and it gives you a snapshot, but it's only for this year. Only when you look at it in accumulation from your balance sheet, do you really understand how this business has been doing for over the long term? So it's only a snapshot for 1 year. Keep that in mind. So here's an example of an income statement where we show our revenues, all the revenues that came in, whether it was cash or if it was on account. And then we have our cost of goods sold, any of those expenses that were directly related to the generation of those revenues. And then we have all of our operating expenses listed down after that. Some income statements will separate depreciation out from operating expenses because they like to see operating expenses or net income before, say, interest, depreciation, and taxes. So sometimes we'll see the interest expense also put down there just so you see what it really is for analysis. But this is a very straightforward, easy income statement that you can use for your own purposes. And lastly, here are some references that I highly recommend for you. Again, I'm sending you back to the SBDC. Well, I don't have the SBDC here, but SCORE. SCORE has some exceptional financial statements or templates that you can use to help you in developing your financial statements. And there are some other examples about how to generate a sales forecast, different sales forecast methods in here. So these are resources that you're more than welcome to go to and look at to help you in your planning process. And again, what I want to remind you, this business plan development workshop is about giving you the tools so that you can go out and develop your business plan. It's the tools that you need. So take advantage of these resources so that they can help you develop the business plan that you want. So I want you to hang on and wait for our last module because it's where we put all the pieces together and we're going to talk about now that you've developed this business plan, you've gone through all these modules, you've done all the work. Now, how do we present that to get those outside, that seed fund, that other investors, the mentorship, whatever else it is that we're looking for? And that is going to be in our next module. So if you have any questions, please let me know. And thank you for joining us. We really appreciate having you here today.